Good morning. Andrew Benioff with Lenrock Group and the Lenrock blog. Thank you for joining us. Here this morning with Jacob Reiter, president of the real estate private equity firm Verde Capital Corp. And we're here at the Capital Markets Conference through Mid-Atlantic Real Estate Journal today in Philadelphia. Jake is, as I said, president of real estate private equity at Verde Capital, private equity advisory investment management firm which provides a vast array of capital products and services to strategic partners. Jake has over 2 decades of experience in real estate finance and previously held positions at companies such as Royal Bank of Scotland and Wells Fargo. Thank you for joining us.
Thank you for having me.
Wonderful. So let's start with, you've been in the industry for quite a while, which is great, and you've been through a number of cycles, and you've also been on both the equity side and debt side of the business, sort of seen things from almost every angle. What do you see is some of the biggest changes of how private equity is investing today versus maybe how it invested 2, 5, 10 years ago?
Interesting question. So when private equity began back in this country, it was done the way I'm doing it, which is really on one-off transactions, raising equity around the transaction, matching the investor and the investor risk-return profile to the operator needs. What's happened since then, obviously, has been the formation of large private equity funds, which invest in certain asset classes. Some do development, some don't do development. And there has been more recently the addition of the EB5 money, which is the offshore Chinese capital coming in. That's been somewhat prolific in the last couple of years, largely in New York, Philadelphia, some of the other large cities, large projects. The related companies, obviously, huge amount of EB5 money in that project in New York. So I'd say fund structures have prevailed.
Okay.
And there's been huge disintermediation out of regulated to unregulated or quasi-regulated industries as the last, and particularly in the last financial crisis, where a number of the investment banks and commercial banks got hurt badly, as did funds. So a lot of money moved to unregulated platforms like mine.
Interesting. And so do you think that you have obviously a number of investors into your platform and can do deals in many different ways? Do you think you have is it an advantage or a disadvantage that you don't necessarily have a pool of capital that you went out and spent months and years raising that's just sort of sitting there? I could see some disadvantages of that, but I also see some huge advantages. Do you sort of see it the same way?
Yeah, so that was strategic. And I did look at a fund structure, and it's not to say we wouldn't do a fund structure. But what it allows me to do is structure transactions, in my mind, in a more creative way. We can do preferred equity strips. We can do joint ventures. We can do hybrids where we trade coupon for upside for coupons. We can do deals where there is an immediate cash flow. And we can build effectively a portfolio for investors around risk-return investments that they choose to do. We don't have pressure to put the money out.
That's a big one, by the way, I think.
It's huge, and we don't need the fees. So we're really not a fee machine. I mean, we're really a promote machine. If the deal works, our operators put cash in, we put cash in, our co-investors put cash in. The deal works. We're all perfectly aligned. We don't get paid until the deal works. And the returns of capital that were targeted and the returns on capital that were targeted go back to investors. That happens on a deal-by-deal basis. We get paid.
Got it.
So that's a unique model. Fund managers make a ton of money, which is great, capitalism. Deals work, they don't work.
Yeah.
Or one deal can take a fund down. The disadvantage to this model, as you've stated, is that I don't have a quote-unquote pool of capital. However, I have very large investors who are interested in not paying fees, who like the direct invest model. They're paying on invested capital, not committed capital like they would in a fund. They pick the deals. I understand what the risk-return parameters are of those investors.
And there's no negative ARB day one for them because, you know, the meter is running.
The meter doesn't run until.
Right.
So if I'm in adaptive reuse projects with some cash flow, there may be a coupon.
Sure.
And there may be some upside.
Yeah.
And I can slice that deal. I mean, I can do that with, I can give them part of the common equity, I can give them part of the coupon. So,
Yeah.
so I can match that investment structure
Okay.
to that investor need. You know,
Great.
endowments like cash flow. Family offices sometimes like upside.
Sure. Sure.
So you can pick and match.
Depending on the deal.
And we're a fairly significant co-invest ourselves. So the operator's putting in anywhere from 15 to 40 or 50% cash, depending on what they want to do,
Mhm.
which is unusual. The operators, coupled with ourselves, we're putting in significant cash. Our investors are putting in cash. So there's really a much tighter alignment
Got
on
it.
that transaction success.
Makes sense.